Portfolio review. Somebody needs to double their size of their portfolio within 5 or 6 years. So let's have another portfolio review. Remember, you can send them in to me for me to analyze. So this individual, and I'll show you what's in his portfolio in just 1 second, wrote to me, said, morning, big fan of your post, and your last post really struck a chord with me. I have a portfolio that has been with Brewin Dolphin for several years and just constantly stagnant every year, and saw your review of followers' portfolios and would be grateful for your advice. Well, I can't give you individual advice. I can give you education and information, but I can't give you individual advice because I don't know you personally. As I have the same situation spread over about 1,000 different companies, scattergun effect. May I send you my downloaded Excel stock holdings? I really don't know who to trust. Fisher Investments have approached me and want to put everything into a single fund. Very scary. And I can understand why this individual is worried. So let's just have a look. Now, you could tell from their email that they're not best pleased that they've got 0% return. And you might say, well, that's obvious. No, there are some people who are 90 years old who will say, just keep my money safe. But a bank can do that and they pay you money instead of charging you. The problem here that I can see instantly at looking at this, and I'm having a quick look at this, is not that they've got bonds. I don't mind that they've got bonds because actually the percentage they've got in bonds is sensible. It's about 10, 12%. That's perfectly fine. What worries me is when you look at the equities. Okay, so they've got about half the money in UK equities through a Lord Debenture Corporation. I mean, you know, that's not going to give you the kind of returns you're looking for to start off with. It's supposed to keep your money safe and give you a bit more interest bearing or yield bearing than you might get in a bank account. And then they've got the other half in global investments spread across 2 funds. Now, the problem with funds is they will have 50 to 100 stocks. You're not going to get the big returns. And this is then exemplified by the other portfolio where the equities are in BP, British American Tobacco, Diageo. I mean, seriously, what's happened is the broker has clearly said, let's see if we can get some yield in excess of the bank account. But what about the fact that the market this year was up 55%? In the US, the NASDAQ, the S&P 500 was up 25%. The fact that an individual's getting 5% yield on their portfolio is not bloody useful if they're not getting any capital gain, or if the capital gain is completely anemic. Okay, so that's the first problem that we've got there. The second problem is then they've put the rest of it in a bunch of funds, and I've explained before, the problem with putting it into a scattergun effect into a load of funds in the interest of diversification, North American, developed Asia, emerging market, absolute return, is that spray and pray approach leads to the IFA being able to say, look, that went up a little bit and that went up a bit and you've got a bit more yield. They're comparing it to a really low benchmark, and what they're trying to do is fool you into thinking you're doing a bit better than a bank account, so it's okay. But they won't ever say, well, wait a minute, the NASDAQ was up 55%, right? So why isn't your portfolio growing and your pension growing? And we need to, first of all, work out what the problem is, and secondly, what the answer is. The problem is that when you put it into a fund, you're putting it into 50 to 100 companies. So the growth ones tend to be relatively few companies, as we know, and we should be focusing on those. Well, how do you find those ones? Let me just show you what I suggest people do. And by the way, I suggest, this is from Goldman Sachs Asset Management, it's not particularly controversial. I suggest they first of all decide how much should be in in fixed income or cash, how much should be in exchange traded funds, which are low volatility, which means low returns. And I'll explain what I mean by that. What I mean by low volatility is volatility about half the rate of Microsoft's, and therefore your gains in 6 months might only be 9%. Okay, low volatility, 7%. Gains in 6 months, 8%. That's what I mean by low volatility, whereas higher volatility, higher risk, slightly higher returns, and we'll come to that in a second. And then the next thing you've got to decide once you've done that with how much in cash, how much in low volatility funds, usually because you're a bit older, you tend to do the low volatility funds, is you then work out, okay, we've got that. Now how much should be in, I want to show this, how much should therefore be in individual stocks, because that's where the returns tend to come from. And we tick the value, growth, income, cash flow, momentum, Sortino, high average return versus low volatility, and high excess alpha, i.e. outperformance of the market boxes. Now, if you'd done that, you certainly wouldn't have picked any of those stocks, and you wouldn't have picked any of those funds, because there are better funds which for the same volatility as those give a better average return. You might say, well, that's past performance. It's no guide to the future. Actually, it's no guarantee to the future, but it's a better guide. So we would have looked at a higher Sortino fund, a higher alpha fund, rather than just those in-house ones that they're obliged to sell you, rather than anything else. And like I said, more importantly, the stock, so that you would have been a hell of a lot closer to, if not exceeding, the 55% NASDAQ return, or at least the 25% S&P 500 return. So you can see what the key problems are. The individual stocks they've picked are pretty rubbish, and they've got a ton of funds where a significant amount of money is, because the IFA wants to turn around and say to the individual, at least you didn't lose anything over a 5-year period. The problem is, over a 5-year period, you won't have got your 100% return, which is what you should have got. Instead, you'll have ended up with making a tiny bit, and all the while they're taking out your fees for the process. So if I were doing it, really simple, personally, and this is not individual advice to this person because I don't even know their age, or maybe I do, it was in there. No, it is this, okay? If I was doing it, I would have personally about 20 stocks which tick the value, growth, income, cash flow, Sortino, alpha box. And they've got to tick every single one of those. And those of you who follow me on Telegram and YouTube know what I got at the moment. For instance, you know I've got Service Now, you know I've got Costco, you know since the start of the year I had Nvidia, you know I had Tesla from January until October, but it was a special situation because it's high volatility. You know I monitor it for 5 minutes every week. That's it, 5 minutes a week, because we don't want to overdo it. And that would have been a far better approach for me. I don't have anything in exchange traded funds because the volatility, low returns, and I have 10% in cash just in case for anything. Okay, and then, as you know, I monitor for 5 minutes every week because it's worth it, because I can double my bloody pension in 2 years at that rate. And I hold for 12 months any of those stocks. If any drops more than 25% from the highest it's been since I bought it, I'd exit. So in the case of, for instance, one that comes to mind, Crocs a couple of years ago went up 250%. Well, if it drops 25% from the highest it's been, or possibly sooner if I get risk averse, as was the case in 2022, where we had to hold a lot of cash because the markets were falling. So that's our insurance policy, monitoring every week for 10 minutes, 5 to 10 minutes, and also ensuring that we have the flexibility to go into cash. None of those funds are allowed to go into cash because that's just in their mandate. They're not allowed to hold cash. Anyway, that's the fundamental problem. I know it's incredibly scary. The IFAs won't do it for you because they need to sell you funds, and I'm sorry, that's why you end up doing it yourself. But it isn't that difficult to do it yourself, because you've got SIPs and ISAs, which are tax-free vehicles, and then what you do with the money is you divide it up, like I said, and instead of 20, you could have 40 stocks, but 20 will usually suffice. And there's a couple of reasons why 20 suffices. And people sometimes say, well, why does 20? Why so few? No, that surely can't be right. Well, it's not because the billionaires also follow the philosophy of most of their holdings in their top 10 stocks, i.e., as Warren Buffett says, put all your eggs in one basket and watch the basket. That's not the only reason, but it's really because if the companies are good and therefore should rise, we want concentration. We don't want dilution and diversification. And if the markets are falling, then the quality companies should protect us. There's less to watch, but they should be so good. That's why there's so few of them, that you concentrate on those. But there are other reasons which are more technical and data-driven, which I can share with you here as to why so few equities. It really comes down to this graph. So once you get past about 20, 25, you're really not reducing company-specific risk much. And part of the reason for that is when the markets are rising, you want not to be diversified, because obviously you want concentration because you want to be going up. You don't want to have some things going down while the markets are rising. And when they're falling, correlation to the downside increases. I've written 18 books on this subject, and I've written numerous, well, about 200 Financial Times columns on this as well. So that's my starting point. Hopefully you found that broadly useful. Thank you very much. Have a look at, for the rest of you who want to go into this, have a look at alpeshpatel.com/links if you want to send me across your portfolio and sort of thoughts on what to do. Thank you.